Welcome to Mortgage Pros 411. I'm Audrey Boisno. I'm here with my co-host Kevin Casey, and Kevin Peranio is pretending he's here, but so far no video. So until we see your face, we don't believe you, Kevin.
Okay, I promise you'll see my face. You're talking. I don't want to steal your attention.
All right. Well, too late for that. All right. Welcome, everyone. Thank you for joining us on this day. It is election day. We are agnostic here at Mortgage Pros 411. We really try to stay in the middle of the pack so that we can keep things balanced. With that being said, I certainly hope you're voting today. There are some important things to address. So with that, I thought we'd start with some good news today. And guess what I came up with? You ready?
Oh, that was hard. What'd you come up with?
I came up with, okay, ready? You're going to love this.
Yeah.
Avocados have the price of avocados has gone down 35% from its peak. How about that?
Is that inflation? Is that inflation rollover?
So here's what I thought was interesting. So they're cheaper by 35% year over year. So we know that avocados had gone through the roof. Everyone's very upset about this, but now they're down a little bit. Groceries are still up 13% year over year, but they're down from the peak. So with that, let's just start with the fact that we have CPI coming out on Thursday. Okay. So we've been watching inflation numbers, praying really that they would hit their peak. We knew, well, we think that this will be, like we've hit the peak, right? And from here on out, perhaps they're going to get better. There are no guarantees, people. It is still volatile as can be, but maybe, just maybe, we've seen the worst of it. What do you think, Kevin Peranio?
Well, I think we have seen the worst of it. I'm a huge fan of Barry and the MBS Highway crew, and they do a great job visually of breaking down the way these CPI indexes is put out there. I'm a big dumb sales guy. I love graphs. I love pictures. And so, all these indices, they have 12 data points. And so last October's data point was a 0.6%, 0.6% increase, which will be replaced by October of 22's number. The projection in the estimate, which, it's like predicting the weather or being an economist, is 0.5% for the Thursday read. Now, if it comes in a little lower, obviously if it comes in at projection, the overall number is going to come down, right? So if it comes in a little lower, if the avocado influence is so high, then, you'll see an even outside unexpected lowering of overall inflation, coupled together with hopefully the certainty of whether we have gridlock in DC or not. I'm not saying, I'm not a financial advisor. I am not responsible for your losses, only your profits, but I could see the stock market ripping this week. Anyway, so maybe it's good.
So the number a year ago that's coming off is what?
0.6.
0.6. Okay. Because in September a year ago, it was pretty low. It was like 0.3, as I recall. Am I correct?
Yeah.
That's been our issue.
So when that came off, inflation had to go up because you're taking a really low number and replacing it with an average number. And now you're going to replace an average number with an average number. And then it's going to seem like, wait a minute, inflation's under control. When in fact, nothing really changed. But
yeah, it's still elevated. It's still at 6%, right? So yeah, it's still elevated. It's still at 6%.
Okay, people, we're going to focus on the improvement. Okay, we know it's high. God, we all go get gas. And by the way, can I just tell you, every time, speaking of MBS Highway, Jake, Barry's son, mentions gas and oil prices and tell us what the national average gas price is, I just roll my eyes and make some probably questionable utterance, because he this morning, or I believe, said that gas prices on the average were like $3.90 a gallon, and I'm like, we're still over $6 a gallon here. Down from $7, but still, I'm like, ugh, God, I wish $3.90 a gallon.
Remember, you and Kevin are above average people, right? You live in the Bay Area, so because you live in such a beautiful area, above average, the rest of us peasants across America, that you pay higher gas prices.
Don't start with me. Do not start with me, Kevin Peranio. That is ridiculous. Okay, there is something to it.
You have to be in the 1 percentile to survive here. That's just it.
Yeah.
Yeah, the 0.6 percentile.
Well, it's always fun talking to people from across the country. You know, you sit in a meeting in Washington, D.C. with, you know, talking about veterans or talking about conforming loan limits, which we'll get to, Kevin Casey, but we'll sit in a meeting with people from across the country and they think that everyone is rich when they make 200 grand a year. And let me tell you something.
They
You're
ain't
making
cutting it
200
here.
grand a year, you have a couple of kids who are doing sports and you're trying to afford a house somewhere around here, you're poor. You're totally poor. So anyway, it all does totally depend on where you are in the country. That is for sure. So
George is at 350, I believe, right now.
what is?
Atlanta, Georgia is, I believe, it's $3.50 a
Well,
gallon.
thank you for that random location that you just pulled right out of your ear.
Hey, there are people from Georgia on our show. You know, come on.
I know. But I always think it's funny where we come up with, you know, Alaska, Ohio. All right, so inflation. So we all say a collective prayer. And by the way, we're all going to keep praying that we have rain in California because we are having uncharacteristic rain right now for November. And oh my God, it's welcome. Although I was with someone in North Carolina this weekend, she was lamenting the fact that it was so, and I quote, cold. So I'm like, all right, you tell someone from New York it's cold here, and yeah, not so much. So, all right, so we have avocado prices down. We've got CPI that might be better on Thursday. It's election day, so at the very least, we will have less signs out telling us who to vote for, which I look forward to because it drives me nuts. So let's talk. I'm just curious. Let's talk about for a moment the jobs report last week, which was interesting because on the surface it looked good, right?
Yeah, it's
But-
11/11. Make a wish, by the way. Make a wish for this apocalypse to end. You know, we had a total lunar eclipse. The sun and the moon passing in the Earth's shadow. It's been raining for 3 days. Cats and dogs living together. Anyway.
Yeah, I wish I was more interested in that stuff, but I am not. So here we are. So Kevin is though. I believe Kevin drove across the country or up the coast or went somewhere once to watch some eclipse, didn't you, Kevin?
That was a solar eclipse versus a lunar eclipse.
Whatever.
They're a
Okay,
little
we move
different.
on.
Although they both tend to drop the weather temperature. And I finally figured out, oh, that's because a lunar eclipse happens at night. And that's going to be cold anyway.
Okay, so
Yeah.
for anyone who'd like to speak separately to Kevin Casey about, you know, eclipses, and you're going to see in a moment something else, yeah, you can contact him separately. Okay, so let's talk for a second. We have a little contest going on right now, don't we, Kevin?
Which
Oh,
one?
you don't. You see.
Casey.
You just want to blow right past the jobs report.
Yeah, we're going to come back to the jobs report because I know
Okay.
that KC has been dying. He is obsessed with the conforming loan limits. I wish he put this much time and effort into, oh, I don't know, anything else, because he has done analysis that would knock your socks off. And you're welcome to everyone that I've tried to rein him in a little bit, because otherwise we would talk for an entire hour and then some about.
Well, it's fascinating.
It
Yes.
is.
Okay.
I mean,
so
it started
I
out, this all started because a CFO called Audrey right after one of the big companies came out with their conforming rate at 715. And he was saying, well, what do you think about it? And go ahead, tell him what you said, Audrey.
I said, I think it's dumb as to raise these loan limits early right now, because why are we doing it? We don't have Q3 results in yet. The market
This was back in
turmoil.
September when this happened.
Everything's crazy. What is to be achieved by raising these loan limits early, right? And I said, what do you think? He goes, honestly, I totally agree with you. And so of course we're off to the races, because when you've got the two who can't get along on the playground going at each other, then one of them does one thing, the other one's got to one up them. So here we are, right? And then a few weeks later, they drag them back down to 700 because, well, all right. Anyway, bottom line is we have this little contest because the actual loan limits from FHFA will be released sometime soon-ish. And
Yeah.
okay, so Kevin Casey, this is your baby. Tell everyone what we're doing.
All right, so we have the contest. Let me see if I can share my screen here.
Yes.
Bear with me. Great.
KP, what?
Bear with me 1 second.
What? I'm letting the spotlight shine on his data.
Oh,
I am
please. Just put
removing
your screen
myself
back on. It's just
as a
confusing.
distraction.
That's fine. Okay, hold on 1 second.
Oh my God, look at, we have a logo. It's crazy.
I know you got a logo on here, but it's not.
I know. Hey, and just for the record, just to remind you guys, we have a YouTube page now. People are actually going to it and watching the videos later. So if you miss something, if you want to refer someone to it, our most recent videos are on YouTube. Thank you to our good friend Jason Bellevue, who has taken that upon himself and it keeps it updated. Okay, did you make it happen, Kevin?
You know, I don't know why it's not behaving. I tried
Okay,
one
so
more time.
moving right along. So just tell them about it.
Yeah, oh, here we go. Now it's behaving. Now I'm gonna share a screen, but now I can't see the screen, so forget it. Just gonna tell all that work I did, not working.
Yeah,
This
KP, show your face.
technology thing is not for us. We know how to do loans, but technology, Kevin, you might as well come on back because I can't. do it.
I'm back. What we
Anyhow,
gonna?
So
All right.
all of our subscribers should be getting an email right about now or during the show, and it has a link where they can go in and guess what the conforming limits are. And because they're on the show, they get a little bit more input or better data because we've asked classes that we've been teaching, hey, what do you write down on your forms? What do you think the conforming limits are going to be? And we get numbers from $600,000 to $2 million. It's like, okay,
Oh wow.
yeah, you guys, you're loan officers, you should know better. You should have a better feel for this.
Okay, stop it with the judgy stuff, all right?
Right.
Okay,
Judge,
now,
Judge.
So it got me
Election.
looking at what is this number going to be?
It's election day. Judge
Yeah.
away.
Yeah.
Okay.
You gotta put your weight in, okay? So it's really fascinating because last year the number jumped huge. It went from, what was it, 548 to 647. That was the biggest rise in conforming limits ever. Okay. And all year we've seen, at least for the first half of this year and end of last year, we saw some really hefty increases in the home value rates, right, Kevin? It was, we were seeing some nice numbers. And that's right up to some company kind of cursed us all and came out with their conforming limits. And since that announcement, the home values have been going down. I'm not blaming the guys.
yeah, that's what did it.
Conforming
Yeah,
limits.
that was
but-
it.
But that's why it was silly to come out with the numbers early because the home value has been slowly declining. We do not know what the September numbers are, and that's about to be announced any day, and that's what will drive the final number. But when I do the projections, 715, they might get lucky if they get 715 now.
They're not getting
Okay,
715.
okay, now hang on. So that's enough tips for today, and that's your guess. Is it?
Yeah,
That's-
that's,
Okay,
no, I'm just saying it's going to be, but it's going to be north of 705. It's-
What's your guess?
My actual guess, I have it arranged right now. It depends what that final number is.
No, you gotta nail it on the head.
You gotta nail it.
Yeah, it's gotta be an increment of $500.
What did I write down? I wrote it down.
okay.
I
so-
wrote it down at, let's go with, here, you want a solid number that I would guess at? How about 708 and
Okay.
250.
Not what you said yesterday. Okay,
Oh.
regardless.
But
Okay,
I'm writing it down right now. It's 708, 250.
this is how it's going, guys. It's on our website, mortgagepros411.com. You can
Let
go
me-
there and vote. The tiebreaker is what date will they release this new number? Okay.
I got you.
So-
I got you. You ready? Let me give you the backstory, okay? So every year this conforming loan amount comes out. It is a mathematical equation,
Yes.
okay? It's based on the home price index. The data
Yes.
comes out every month, and then whatever it goes up by, the conforming loan goes up by, and then the high balance pivots off that and all the other stuff. It's a mathematical equation, which is why everybody jumped on it. Home prices peaked in May, and they have been coming down since then. Every monthly reading of the home price index, the Case-Shiller, and that information. As of the last reading, okay, which came out at the end of October, which is basically September data, that conforming loan amount was going to be $709,500. Now, remember, you're right. The big boys in Detroit, Rocket and UWM. I mean, it's like watching a heavyweight fight. Which, by the way, UWM was number one in Q3. I'm just sure you
Yep.
guys saw that.
We
We have a
saw
new
that.
number one.
Saw that.
So so Rocket came out first a whole month earlier than everyone did last year. Now my
Yes.
team, my awesome product development team, my VP of product development and training, Laura Roush and her team, they're ready. They're at the ready. As soon as this thing grows, like we're nobody, we're not a lender from Detroit, but we're always announcing the same day everyone else, and we're live within 48 hours completely, and we're taking locks immediately. So we're always like
Yep.
the second or third lender in America to be out, just for what it's worth. All right, I'm not going to brag about PRMG more. So that backfired because now the loan amounts come down, and the next reading will come out Tuesday the 29th. It's an exact day, so there is no tiebreaker. It is exactly the 29th.
Well, no, it's still a tiebreaker because they would have had to have watched this show to know that answer.
Well, and what we,
well, there you go.
okay, so what we've looked at before was it comes out on a different date every year. So it's good that
it's the Tuesday. It's basically the last Tuesday of the month. So November Tuesday 29th, the October data will come out. And the only reason I know this is because I read this in the Crispin blog, I believe. And so if we are down to 709,500, I'm going to throw my guess at 703,000. So I'm going to go out with 703.
Wow.
The only reason I did that is I basically took 715 minus the 5,500. Kind of rough same coming down from 709,500. That's just what I'm going with. I'm going 703 on the 29th. It'll be announced. Program live, then up and running, locks available. And for those locks that we did over 703 or everything up to 715, we're screwed. So we have to either put it in a jumbo loan and hope that it
well, you know what, you're
jumbo
really
guidelines.
You're really screwed is I also believe that we will repeat the same number next year, that it won't increase.
All right.
Oh, it might go down. It might go down.
Yes.
There's a lot of people prognosticating single digit home price decline year over year. We're at 10.2% up, I believe, year over year. So it's still
just revised.
I'm putting in my projection for 2020 or 2024 already, and wherever the conforming limit comes out in the next few days, I believe that will be the same number for the following year.
See, those are all Tuesdays. Look at that.
Okay, so Kevin Camara is asking, what about high balance? We are not going there.
Yeah,
Don't even get
high balance. High balance.
Don't even get these people started. No, that's enough.
No,
Okay.
high balance is very simple. It's
just pivots off the number.
It's just a calculation.
And that means that at 150%, it's at least guaranteed to be over $1 million for the high balance. And that's a problem all by itself, because a lot of jumbo lenders won't do a jumbo loan for less than the high balance limit. We have that in San Francisco. It's a problem.
That puts you at 1 million. If we have a 703,000 conforming limit, we're at 1,054,500 on your high balance.
Yeah.
Now,
but I would just like to say again that I haven't done a high balance loan since they raised the high balance limits last year, because I just stick everything in jumbo because the pricing's so much better. So by the time you've had all the LLPAs, forget it. Like, I don't know. That's what I found anyway. So hopefully everyone else is having better luck. With that being said, go to our website. It's the Crystal Ball Mortgage Pros 411 Crystal Ball contest. Put your best guesses in there. You got a lot of hints today, a lot. And so with that, we are going to keep it moving, shall we? Although we lost KP again.
No. I'm here. Keep going.
Okay, so now let's talk about that jobs report last week, because it came in above expectations. 261,000 created jobs. Apparently, they had a revision for the last 2 months of another 29,000 jobs. But there was something really interesting about this jobs report. So there were 328,000 losses, but there was something, and I have been railing on BLS's jobs reports for years because they're all so wonky. You know, they come out with their jobs report, then they revise them. They're huge market movers, drives me nuts, pisses me off. So, but I just learned something new. They do this modeling. I should have known this before, but I didn't realize to the extent that it was impacting things. So they do this birth death of businesses, just to be clear, modeling,
Mhm.
projecting what they think is going to happen with job creations or business creations and losses. And this jobs report had 455,000 birth death modeling, 455,000 in there. That's unbelievable. Kevin Peranio, any thoughts on this?
Yes, of course.
I
Well,
know, of course. All right, go. Enlighten us.
again, I got this great breakdown from MBS Highway. Your prior guest, Barry Habib, we all know and love. There are two components that make up the jobs report, right? And so one of them is that modeling, like you said, and it was like what, 453,000 added birth death numbers.
455. It was just,
Yeah,
it's
which in the survey, which is the other component, where they make 60,000 phone calls and they go, do you have your job? How's it going? What's your income range? 380,000 lost jobs in the actual
328. 328.
328. Okay, I thought it was 380. Well, there was another article that came out in through my Stansberry research that I paid a stock subscription for. They said it's 383. I think you're talking about just the high income earner number, but the total number in that report, which because Barry only highlighted just the high income earner number.
Gotcha.
But
Okay,
in
great.
the total report, it's actually higher. There are over 380,000 lost jobs in the 60,000 person survey, but that got covered up because of the increase in the birth death ratio. So there's a net 260 something thousand added jobs, but there weren't, right? So I'm no conspiracy theorist, but it is election day. So just throw them all out there, you know.
I haven't suspected conspiracy on those job numbers for years.
I've always thought they were bupkis. I mean, they're just always total crap. And so, but they move the markets. The rates go way
Move the
up
market. Now,
and they're like,
if they can only show the numbers a month back, because those seem to be more realistic numbers when they adjust. And it's amazing because no one ever in the reports ever watched the adjusted numbers.
I got a bold prediction for you, because every single month this year, there's been an upward revision when they get the past it. Because remember, the October jobs report, they're doing these 60,000 phone calls. They're getting data in and compiling it. It's usually the second half of September and the first half of October where they're gathering their information. Then they compile it for the last 2 weeks of October to create the report that comes out on the first Friday of November. So the November jobs report, which will come out the first Friday of December, will have the second half of October and the first half of November information gathered and compiled over 2 weeks. So it is a little bit lagging because you can only make 60,000 phone calls and gather the data so much. And the upward revision in this October report was only 25 or 29,000, the smallest upward revision of the year. My guess, this is another bet, is the November jobs report will have our first negative revision for the past report, which would be the October report that came out this past Friday, conveniently positive right before the midterm election. And oh, by the way, don't forget, because of labor participation going down only 0.1%, okay, because no one's talking about the side hustle, the gig economy, the 10% or more of us have some kind of side hustle, which is why there's so many job openings. But the unemployment rate went up from 3.5 to 3.7%. Still a good headline number, but my guess is this November report, we'll see downward revision for the October report. We won't see as high as 261 jobs created, and we'll see the unemployment rate go up a little higher, which is good news. If you're on Fed watch, wanting to make sure that they're finally going to pause in December and do nothing more than 50 bips. The CME tool says that there's a 52% chance that they only increase the Fed funds rate in December, the next meeting, by only 25 basis points, not 50. So that's the first time I've seen that too. So you're starting to see avocado, moon in the umbra of the earth, 3 days of rain in Southern California, and all this craziness going on all at the same time.
Hey, used car prices are down over 10% year over year too. That's a first. Well, it's a second actually, but I mean, they were just going through the roof to the point
You
where,
missed your opportunity to sell your used car for a fortune.
you know what? I love my car, so I'm not doing that. So who cares? All
I
right,
gave mine to my sister. Well, we gave ours to my sister, and we
your
got it
car?
appraised. Yeah, it was my wife's old Lexus ES350, just sat in the
Mhm.
front. So we got it appraised at the height of the boom, and you use that Manheim index, which is the index, another index that's used to evaluate used car prices. And we got it appraised at, AutoNation. Used that for our tax write-off and just gave it to my sister.
You can give it to a relative after as a donation?
Heck yeah.
What? I thought I figured you would have figured out what the high blue book or whatever Manheim would have been, and then sold it to your sister at a premium, but that's just me.
We won't
Anyway,
ask you how
No
you did that.
way.
I'm
Because
kidding. Jeez Louise, don't be so serious, people. All right, manufacturing has declined for the seventh month. Seventh. Don't worry, we're not in a recession. Everyone knows.
No. There weren't big layoffs on Friday, the day after the jobs report.
Oh my God. Okay, that's a whole nother thing. So we'll get there. 10-year auction tomorrow, guys. So we have 10-year auction tomorrow. We have CPI on Thursday. The volatility is going to continue. Keep your eye on the ball. And just remember that we always have more to lose than to gain. Like those rates always go down way slower than they go up, don't they? And the knee-jerk reactions are going to be fast and furious in the wrong way for us. So just don't take your eye off the ball. Don't get complacent. Don't start thinking, oh, we're fine. We're never fine. It just,
keep going. Hey,
stay the
Kevin,
course.
would you say that the Fed not raising it by half a point or 3/4 point is a pivot?
So there are 3 steps. Well, look, the definition of pivot has been redefined. The pivot every year before fighting this inflation is when they actually cut rates. But now I've heard it. I heard some analysts say it's a 3-step thing. So I didn't make this up. So the first step of this newly defined pivot is that the increments get smaller. So we've had 4 75s in a row. Anything less than 75, which is highly anticipated to be 50. Now the Fed is step number 1.
Yep.
Number 2 is a complete pause.
Yep.
Okay. So
What's a pause for how long?
Well, that's an interesting point. So before the last Fed meeting, everyone thought they were going to do 75 in November, this last meeting, 50 in December, and then pause. Okay. Now you started getting people thinking, after his hawkish tone came out, his rhetoric, the Fed's rhetoric during Q&A is now a tool of the Fed. It's not just the written statement, which if you look at my LinkedIn video, for those that follow me, I posted last night, completely delirious, at 1 a.m. They said, we are going to look at the cumulative effect of all the raises we've already done, because they know that there is and they also use the word lag, that all this medicine in the system, this 4% Fed funds rate that's out there right now, they know that it takes time for it to make credit more expensive. The more interest rate sensitive stuff, like our mortgage rates, we're in recession already. Housing's in recession. Car prices are the highest they've been in years, the rates. Obviously, borrowing rates for all kinds of stuff that's tied to any kind of treasury rate, all more expensive, which makes demand go down, which we all know. So the lack of credit, which is what makes the world go around, there's $50 trillion in credit. There's only $3 trillion in cash in the world. Credit is what makes the world go round. Credit is now shrinking, as is the money supply. So that will then curb demand, because everything's more expensive to borrow, right? Which things are more expensive to pay for anyway. So people are now blowing through their cash reserves to live. So getting back on track, the Fed was likely to go 50. Some people, when he was talking, then said 25 at the February meeting, then the next meeting. Now people are thinking they're only going to do 25 at the December, and then maybe 25 in February. I personally think they'll do 50 in December and then completely pause February 1st. And if the interest rates and mortgage have not already ripped by then, they will absolutely rip and come down as of February 1st. And it can come back down. I could truly see us being in the high 5s range for 30-year fixed rates, the Freddie Mac interest rate, the average rate. and you want to talk about borrowers, they're on the sidelines. I attended Housing Wire Summit. I was invited to the CEO forum. We had a really great data analyst in there that does MLS insights. She said people are lurking and engaged on listings like never before. They're looking. And just like all of us shopping, we're looking for a deal. As soon as rates come down just a little bit, bam, this household formation people, they're going to come off the shelf. And I'm telling you, if you are out on the hunt right now, you got your borrowers looking right now, tell them lock it in now, do a 2-1 buy down now. We'll refinance them later. That house, if you see it, get on that thing right now. Get the seller to pay for your 2-1 buy down. Because I'm telling you, I think the spring purchase season is going to be an upside surprise, especially if the Fed hard pauses in step 2 of a pivot and rates come down and normalize. People are going to come off the shelf, and that house you're looking at, especially if you're a first-time home buyer, is probably gone. Phase 3 of a pivot is when we're actually in a recession, which requires job losses, which we've already seen, obviously, in our industry. There's more to come. A lot more have been announced this week. Meta, Facebook, looking at 87,000. Twitter cut half their jobs. Amazon's in a hiring freeze. If after Q4, their peak season, they'll probably lay off because they don't need the bodies in Q1. You start to see job losses. That feeds into the recession narrative. I don't know if we'll go into a recession. If we do, it might be mild. But all those things are what is necessary for phase 3 of a Fed pivot, which is actually cutting the rates to stimulate the economy. But the Fed did say, Jerome Powell did say in his rhetoric, we may stay at this elevated rate wherever they pause at, whether it's 450, 475, or even 5. They may stay at that rate for a longer period of time than you think, because they got to get inflation under control. So that's still good, though. I mean, housing has 30-year interest rates in the low 6s or even high 5s for an elevated amount of time. That's still better than renting if you're on the lowest 25% of the economic totem pole for renting, and the median price for rent is actually better at the moment, but that could flip back down with just a little bit more reprieve in rates. So it's game on in the spring purchase season.
Rates. Actually, I'm a big fan of buying right now. It's like, to me, it's screaming opportunities to buy.
Me too.
You can negotiate with the seller. You can get that credit for the 2-1 buy down, or just 5 points down. The real cool thing about that 2-1 buy down is that that's a credit that sits on your account, that if you refinance, you get that whole money back, which is kind of cool.
Absolutely.
I thought that was interesting. I'm curious. I've watched a couple of presentations on the 2-1 buy downs, and it definitely was not what I remembered from 2,000 years ago when I actually did one. So
well, the permanent buy down, if you look at the tools on MBS Highway that Barry put out yesterday, there's actually a comparison between the 2-1 buy down, a permanent buy down, and then I think there was a temporary 1-0 buy down. I think was the difference. The 1 point buy down can be a lender credit, but that's for 1 year. The 2-1 buy down, after 2.5 years, the borrower wins in a permanent buy down of the rate, which is just paying points to have a lower note rate.
In which case, it doesn't make a whole hell of a lot of sense.
Yeah, I mean, exactly. I mean, you could.
That's the whole thing. That's what I keep wondering when I look, and especially when I start seeing what these buy downs are costing. I'm like, okay, so if you're talking about rates potentially going down by February, and we had Dr. Elliot Eisenberg on, was it last week?
I think the latest by February 1st. I think it'll go down before that. I'm the ever optimist, but I don't think they'll be at this elevated level any beyond February 1st, in my opinion.
Okay, so he was saying like summer, and we've heard a couple of other people say summer. So, but again, here's the good news for all of us. Potentially, the pain will be easing at least a little bit shortly. With that being said, I thought it was interesting because I had somebody who's not in the mortgage business mention Open Door to me, and or OfferPad actually. OfferPad's at 76 cents a share as of 2 days ago. And in Phoenix, apparently they've got 1,500 listings that are underwater for them. Like they're up for sale for less than they paid for them. And then Open Door wrote down their home inventory by $573 million.
Better than paying taxes.
All right. That's nice. Great. But the point is these companies are not thriving at the moment. So, gee, that's too bad.
Who is?
I mean,
Nobody.
we're doing great. Shut up. It's fine. Okay. So speaking of
Actually, there's some smaller, little tiny mortgage companies that are expanding because they're growing right now because they started out as zero, so they can, if they get a couple new accounts, they can grow. That's about the only area where mortgage industry is growing.
Well, the other thing, the new guys don't have the legacy loans on their books that they can't sell or securitize, et cetera. And so we have talked about this ad nauseum on here where, we're talking about, like, especially in the non-QM arena, don't go chasing the lowest rates because those guys are having huge issues. We're watching a number of these companies exit. And it's a lot of it is because, if you're going to the market and your average note rate is 7 something and somebody else has got 10 something, who's going to sell? So the companies that were more aggressive and more forward thinking with, okay, we got to have higher rates, they are the ones who are surviving right now from what I'm seeing. What are you seeing, Kevin Peranio?
I'm seeing some amazing comments that are appropriate to this. My boy Dirk out there, he was talking about
Dirk's
the man.
Guy. What can we say?
He's a man cut from my own cloth. He's a smart ass. So
Do you know him?
Yeah, I love Dirk.
Yeah, he's a good guy.
I wanted to work for PRMG. I don't know how many times I got to chase his ass. I said they must not be counting mortgage businesses in their death rate. This is true. There have been, as he knows personally, there have been some shutdowns. Mostly in the wholesale channel. Mostly in the wholesale channel. Marry the home, date the rate, and divorce the rent. That's the last part of that, Brant. You got to throw in that divorce the rent. Look, you have to distinguish between a paper and non-QM. And I'll say it again. I said the last time I was on the show, Dodd-Frank worked. I know we hate. You're welcome, Grant. We hate. Okay, regulation. And I think gridlock in DC.
We don't all hate regulations.
Well,
KP.
Okay.
We hate over regulation. How about that? I'll settle on.
Yes.
We hate too much regulation.
Yes. And look, I mean, we're going to get into credit scoring later, but that's a regulation that's coming from the FHFA, which, look, they're trying to be more inclusive and get more people in the houses, which, don't we all love that? That's my favorite
100%.
thing. Is everyone in the mortgage business is like a closet liberal because we want more people to have homes too. We want people to get into houses that were shut out in the past. But let's not go there on election day. So look, in Dodd-Frank cut out non-QM away from Fannie, Freddie, and Ginnie loans. So the A paper world is protected and it held up. Now, what the problem with that is that little segment of non-QM loans is very volatile. And so there are different types of non-QM lenders out there. There are those that secure financing. I don't name any names, but let's just say that you go to an insurance company and they say, we're going to give you $100 million or $500 million in secured financing, and we're in it with you, thick or thin, whatever's going on with the roller coaster rates. Then there are non-QM lenders, some typically smaller, that are selling on the flow. So they're locking with you, the originator, they're underwriting your file, closing, funding it, have a nice day, bar, happy to help you with this loan because you're one day out of bankruptcy, and then, at only 20% down, and then they have to securitize it, wait for all the other loans to get together, and then turn around and sell it on the secondary market. Oh, by the way, rates have shot up in the meantime, so that 7% note rate that you closed and funded in that small little non-QM lender securitize at, no one wants to pay for a 7% rate when they get 9.5% out there in the market, the buyers on the flow. So the lenders that have to sell on the flow are very challenged right now. Have they also seen their peak of rates and challenge? Maybe. So maybe we might not see any more of that if they just hold on. I'm predicting that the rates we saw, the 10-year, kind of getting close to 4.3, the highest 7.15 Freddie Mac rate, the October 13th number, I'm predicting that will be touched one more time, but that's it. It won't be broken, and we will fall back from there. So what you're seeing, Aubrey, what you're talking about, these lenders that are shutting down because of rate volatility, they're smaller non-QM lenders or non-QM lenders that sell on the flow and don't forward secure their money and know that no matter what the rates do, they have a home for it because they got maybe insurance money or some Wall Street syndicate or something that's gonna, no matter what, even though they could get a better deal, they're gonna actually make good on their word and pay for that loan, even at 7% when the going rate's 9.5.
But what we're seeing is they're not all keeping their word, and their warehouse lines are being shut down all over the place. I mean, we are hearing on the back end a lot of things that we don't really talk about until they're more public, so that the last thing we want to do is make something worse for a company or for anything. So it is shocking the number of changes that we're seeing. And again, it's just like pinning Jello to the wall. So if it seems too good to be true, it's too good to be true. And just hang in there, guys. There's a lot that we can be doing right now. I'm a real proponent of, you know what, get 2023 into your sights right now, get a plan put together and start it now. There's no reason to wait till January 1st, but in the free time that you may have, because you're not closing 26,000 loans a month, make your plan for next year and get going on it. Again, get out there in the community, go to events, have a Christmas party or a Kwanzaa party or a whatever.
But also
party.
use the knowledge that we share on this show. For instance, the 703 conforming limit. Now you know what an idea what conforming limit's going to be in a few more weeks. And you can steal a loan that would have gone to a jumbo lender or it would have been a high balance. And now we just have to wait. We can get 703 and I can get you in. I had a client who's buying in Palm Springs, and Palm Springs does not have high balance loan limits. So I was able to no, the home you want to do as a conforming loan in order to do this loan right now would be a jumbo loan for you, but just wait 3 more weeks and we can get you through on a conforming loan. So it's
I love that you're already using my 703 like it's just going to be in there. To be fair,
well, if it's not,
that's a guess.
So much crap. Let me tell you.
We'll talk next week about the last 3 digits of your 703.
Oh my God. Oh God.
Yeah.
Casey has a whole analysis of the last 3 digits of the loan amounts. Oh my God. He's got graphs. He has Excel spreadsheets. I have literally, I'm like, he's been so excited about this. I'm like, okay, I get it, but not everybody wants to take a deep dive into projecting the conforming loan limit. So
doesn't it have to be an increment of 500? Maybe I
no, their increment is $50.
Oh, okay, got it. So okay. I apologize. I didn't know that. All right.
Okay.
So
that's just part of it.
That's okay. Casey knows it. You don't need to know.
My boy, Josh Tyndall from Atlas Title. Those guys are awesome. Love them. I didn't say sub 5.5. I said high 5s, under 6. So low 6s, high 5s. That's where I got us at. Sub 5.5 is even too aggressive for me. But thanks for calling me out, brother. Oh, and you had a great question. 30-year, 15-year, 5.1, what has the best rates? Now, because of the 10-year, 2-year treasury curve, that yield curve, ARMs aren't exactly great price right now. People don't want any banks, aggregate investors. Nobody wants any loan right now because they know they're all going to pay off next year in Q1 or Q2. So ARM rates aren't exactly great. And 15-year, obviously, because the amortization is half the time as a 30-year, the payment's so much bigger. I think your best bet right now is a 30-year fix with a 2-1 buy down. And I would say don't sleep on government loans right now. FHA rates are fantastic. I think their rates are starting off at a note rate permanently are much better than a 30-year fix. I don't think you can do it too.
Knocks it off though. I've done the math and it's.
Well, I think
that could be changing. That could be changing.
But
it's not. Okay, so we heard that at the Mortgage Bankers conference, which I know you were there, that HUD said they're not looking at that right now. They want to see the dust settle on the market before they start getting rid of the 50 or the straight line.
They are looking. They are waiting for their next actuarial report to come out. So and their process is a little more involved. Let's just say that. So I wouldn't say it takes an act of it doesn't take an act of Congress, but basically. So
we have Julianne Joseph with FHA. She's a
she's the best. She's the assistant
oh my
deputy.
God, don't you love her? I know. I
love her.
In a couple of weeks, so she can give us the you know, the ins and outs of all that.
Maybe we want to talk about credit reports.
Yep, but hang on quickly. I just want to make sure I mention, guys, stay in touch with your clients right now, because as soon as people start doing refinances, everyone will be all over your clients. So send Thanksgiving cards, then send Kwanzaa cards, send Christmas cards. Apparently nobody celebrates Hanukkah according to my Jewish friends, but if I'm wrong, send a Hanukkah card, whatever. Find some reason to stay in contact with your clients and do it now and do it continuously. Okay. So I just want to make sure that we are throwing out ideas for you guys to be working on right now, not just sitting around lamenting the days that we have red in the market. And so, yeah, we do want to cover a couple things before we wrap this up, and we're going to run out of time. I can feel it. So we have FICO fees that I want to talk about, and credit scores, which we've talked about the credit score changes that are coming with Vantage 4.0 coming into play. But my understanding is, according to my CRA, the credit reporting agencies, not until 2024. KP, are you hearing something sooner?
Oh, yeah, definitely.
Okay, talk to us.
Yeah, and by the way, just to tie the reason why we talk about this stuff, and we talk about where we think loan amounts are going, where we think rates are going, because our borrowers are thinking this too. I see a bunch of Q&A questions, and
oh my God, somebody said, are we sending Thanksgiving cards to our Native American clients? Oh God. Okay, really?
Well,
Maybe
there is the Indigenous People Day. I think that holiday was last month. Anyway,
yeah.
So yes, your borrowers are thinking the same thing. Should I wait? Should I wait? Should I wait? I'm gonna wait for home price to come down. I'm gonna wait for rates to come down. And some of your borrowers like, I'm gonna wait for rates to come down and home price to come down. So it's very important for you to say, well, they did come down. You can do a 2-1 buy down. And when they actually come down, then you could refinance permanently into that lower rate, and you secured the house you want, because we're in a seasonal market. And I'm telling you, purchase business is going to pick up after the new year. It always does. It can't get much worse than it is now. So there's a lot less listings out there. And I'm just telling you that, you know, it's all about price action, right? If there's less houses for sale, it takes less buyers to take off the market, which you might actually be looking for.
Yep.
2-1 buy down. If you lock at a 7% rate today, okay, let's say you pay $8,000 to buy down the rate. That means year number one, for the first 12 months, your borrower, even though you have a permanent note rate at 7%, your borrower's payment is only based on 5%. That's the 2. Then the second year, you're only down 1% from your 7% note rate. So you pay on the 6% payment months 13 through 24. Then months 25 and beyond, you go back to paying the 7% payment. So your payment is down for a year, 2 points, only down for the second year, 1%, and then goes back to the 7% note rate. Do you think rates are going to come down in the next year or two, so then you can permanently refinance that 7% borrower's note rate to wherever we land, low 6s, high 5s? Yes, that's what a 2-1 buy down is. Okay, credit reports. Can the buyer pay the buy down? Yes, on a 1-0 buy down. Okay, you can buy down a 1-year lender paid, where the borrower can pay or the lender can pay at a yield spread. If you try and pay down anything more than 1 point, you're not going to pass your high cost test in your QC thing, your Maven tools, or whatever your tools are within your system. So if you're buying down 2 points or more, you're going to have a high cost loan for the borrower. So then the seller has to pay for the 2-1 buy down fee, or even the 3-2-1 buy down fee. So the buyer or lender can pay down 1 point. Hope that makes that clear. Okay.
And make sure on the LE that you're showing the seller part under, don't put it as a credit. It's got to show it's seller paid.
It's
so
very complicated on the LE and the CD.
We're talking to someone about coming on and doing a buy down little tutorial. So stand by, we'll get that done. And just quickly, somebody asked if we can do FHA for rental property, and the answer is no. Well,
you can if you buy a 2-unit building and you're going to rent one of the units and live in the other, and that is like the best deal in town.
Well, units are one thing, but if you're doing a single family, you can't do it. It's not a rental. It's not a loan for rental, probably, unless you're going to own or occupy it.
I also believe that if you originally bought a home as a primary with an FHA and convert it to a non-owner,
that's fine.
You can refinance that.
That wasn't the question, right? Okay, so quickly, because again,
credit reports.
I knew this was
Yes.
gonna happen. Yeah, okay, and by the way,
All right,
Kevin,
got
we've
this.
talked about this before, just so you know, so they have some background on this, that, they know that FICO has decided that they're going to raise their fees to the 3 bureaus, and, that there is some controversy, which I think is really interesting. There are tiers, there are 3 tiers. So there is a list of lenders who is going to have a much smaller increase than the second tier, and then the third tier is everyone else, which is, you know, your average broker. And a lot of companies that you would have thought would show up on the list did not, as far as being in one of the first tiers. So anyway, and it's the weirdest thing that I've seen, because okay, the no one's supposed to be talking about this except,
Oh, no one's supposed to be, but
right?
I'm telling you, it's,
We've already gotten our notices that we're not supposed to be talking about this.
I haven't, nobody gave me a notice. Okay, so I'm going to talk
Yeah,
about it.
well, I ignore
Because
that kind of thing anyway, so let's go.
First of all, it's
Quick, Kevin,
unintended,
we're gonna run out of time.
it's unintended consequences. Okay, right? So this is just my take. Okay, I have the right to free speech. I don't know everything that's going on. I'm not gonna cast blame, but the FHFA director, Dr. Sandra Thompson, the director of FHFA that oversees Fannie and Freddie, okay, she announced on the Monday of the Super Bowl, the Mortgage Banker Association National Convention. There's always a big announcement. This was the big one besides the LLPAs, that the entire credit scoring ecosystem and everything you know about credit scoring will be changed in the next 2 years. Okay. So right now you get a tri-merge credit report. So you get a credit report from Experian, TransUnion, and Equifax. The algorithm model that those credit bureaus use is called the FICO score, FICO. FICO is an algorithm.
Yep.
Okay.
We had a guy on the show once who helped create FICO. It's interesting.
Well, let's hope he had nothing to do with creating the pricing schedule. So the announcement from Dr. Sandra Thompson was that we no longer need a tri-merge, you need a bi-merge. Okay. So that means on every credit report, one of the 3 bureaus is out. So there's going to be some competition now, right? Instead of them all getting money every time, now they got to compete. Maybe that will be better for price, maybe. Okay. Now on each of those bi-merges, whichever 2 of the 3 you use, now there's an added algorithm. Okay. So the FICO algorithm, the FICO, is now being upgraded to the new 10T. That T stands for trended data. So FICO is changing their algorithm. They're using trended data, which takes information even from 24 to 30 months back. Okay. So they think that trended data algorithm will be more inclusive and help borrowers that were in the past shut out from obtaining credit for mortgages will now be included, and there'll be more people able to get credit because of the new 10T FICO algorithm. But on that bi-merge from each of the bureaus, there's a second algorithm, and that is the Vantage score. So we've never used the Vantage score, and it's been written about a lot for years, and they've been collecting their data. So the Vantage algorithm, which is the 4.0 version, by the way, there's been 3 versions. Now, 4.0 Vantage algorithm, the 10T trended data FICO score will be on one of your bureau credit reports, and then one of the other 2 will have both those. So 2 bureaus, each providing you 2 algorithms, a total of 4 algorithms in your bi-merge. So that implementation schedule is in the next 2 years. It will change the game. I've seen some analysis of, are the FICO scores, maybe it's a little lower here, a little higher there. But between now and then, guess what? FICO has decided to create what's called tiers. Now, my understanding is FICO. Okay, so right. I'm gonna do a caveat so I don't get sued. This is what I was told by ear. So I am not a financial advisor. I am not responsible for your losses, only your profits. Don't take my word for it. Do your own research. But I've had many C-level executives come to me and say, Kevin, say something, because this is BS, because my credit report cost is going up for the next 2 years because FICO, okay, supposedly it's FICO, is now creating what's called tiers. Tier 1, okay, these are lenders that do a ton of credit reports. but maybe not necessarily. Then there's tier 2, so your prices will go up. And there's tier 3, your price will go up. I was told so we pull 500,000 credit reports in a year, let's say, for example, and we do about 100,000 fundings, okay? Now, the tier 1 pricing model is based on your tri-merges, which is for the next 2 years of pulling FICOs, based on just the 100,000 that you pull and fund. So my 400,000 pre-quals or getting them ready in the pipeline, they don't count for my tier status. So I'm just 100,000, a measly little 100,000 a year tri-merge FICO credit puller, not a 500,000. So now my pricing tier kicks me down to tier 2, which may double my credit report score for the next 2 years. So I could go, from maybe 25 or 32 or 36 or whatever we're paying. I don't know what it is. To doubling that. If I'm tier 3, 5x. My credit report bill could go up 500% because FICO decided that tier 1 doesn't count the 400,000 units that I'm pulling. That's how I was explained by a credit vendor. Don't take my word for it, FICO, if you're listening, but trust me, the C-levels are pissed. And oh, by the way, an internal email talking about this tier 1, 2, and 3, saying who the chosen winners are, which there's really, this data and the way that tier 1 is chosen, it appears on a perception, I'm not saying it is, but by this internal email that went around, it looks like some winners were chosen, okay? All right, that's what it looks like. And I'm telling you, people are circling the wagons on lawsuits. I have brought this up with the NBA. They are referring to their antitrust attorneys to see if they can even weigh on the issue, because this is maybe vendor specific, which FICO has a monopoly and maybe taking advantage of this. And so everyone's afraid to talk about this, but we're the ones that are pulling the credit scores and trying to get people in the houses, in the communities, especially the hard. This will affect low to moderate income borrowers.
Absolutely.
If IMBs like mine and yours, Kevin, get this lower pricing because of the way FICO is collecting the data, not counting my 400,000 pre-quals, then I got to pass on higher price credit reports to low to moderate income borrowers.
Right.
I think that's bullshit.
Well, and to the tune, these are not little differences. These are
No, huge.
pretty huge differences between the
$80 credit reports.
And by the way, I would just like to point out, like, this in a system where, like, really they're not making enough money. I mean, I just cannot even wrap my brain around this at this point. I mean, our information is being sold without our permission. I know it's not FICO, but still, it's the credit system. The credit system, in my opinion, is just like, I think mortgages and appraisals, we need to throw it all up in the air and start over again, because this is some crap. So with all that, we are literally at the top of the hour again. I knew we were going to run out of time. I had a feeling. Kevin Peranio, we just want to say thank you. You are always absolutely a delight and full of information. If you have not caught his updates on LinkedIn, they're really worth listening to.
Follow them on
I wish I
LinkedIn.
got an email saying when they were posted, because
Okay,
I don't get all of them.
I apologize. Thank you for the plug. You guys asked me to be on your show. You said pick a date. Here are your options. I'm like, oh yeah, election day for sure. So yeah, follow me on LinkedIn, Kevin Peranio. And I'm actually starting to put out with a little more polish, instead of me just holding my camera in my hand and getting hit by cars or my webcam. I'm actually getting a production team. Kathy Ireland's son is producing some videos. I'm trying to put out some financial literacy videos, just talking about topics. I'm gonna run to my office now and film my third one and talk about, and I'll give everyone a heads up here if you're listening here today, all 148 of you. We're gonna talk about elections and why they matter as it relates to fiscal policy and why politics sucks and it plays with our emotions, and have the emotional intelligence not to be played with. Vote with your pocketbook, math, science, data, and facts. And if you don't vote, your opinion doesn't matter and you can't talk about politics for the next year.
All right, that's fair.
And
All right,
speaking of
with
which,
that,
we've also done some updates. Check out our website. It's now active and functioning. You can pull up past videos on our YouTube channel or go through the website and get them.
well, the website doesn't quite have the link, but that is next. We're about to link the website with YouTube.
And then answer your guesses. We do have a nice prize, because whoever gets it will be we'll make some nice news on them.
All right, there you
Thanks,
go.
Kevin.
Thank you, everyone. We'll see you next week with Laura Brandeo. She's always a pleasure. We love you. Have a wonderful week, and we'll
Laura's
see you
the
guys on
best.
Thursday.
I
All right.
love Laura. She's
Yeah,
the best.
yeah, she's great. All right, guys. See you later. Have a good one.
See you
Bye,
next week.
everybody.
Thank you.